back to Jacobism, lovely people. In today's video, I'm going to share with you how to invest. It can often feel as if the world of investment is like some secret invite-only club with their fancy acronyms and box plot graphs. However, I'm going to show you that once you understand some basic principles, you will know the what, why and how of investing, and that it is actually quite simple. Without further ado, let's do this, people. Now, in this first point, I'm going to share with you some of the things that you need to consider before investing. Number one is asset classes. Asset class is a term to describe a grouping of investments that have similar characteristics and are subject to similar laws and regulations. For example, real estate or property is an asset class, but within it you have commercial and residential real estate, which are subject to similar but different regulations. There are four main types of asset classes. Number one is equities, also known as stocks. Number two is bonds, also known as fixed income. Number three is cash equivalents. And number four is alternative investments, in which you have property, commodities, and private equity. What is important to note about asset classes is that they each have distinct characteristics, and these characteristics are inherently correlated to their risk and return potential. Number two, the risk scale. Imagine you have on one end least riskiest and at the other end most riskiest. Risk and return, the point of investing, are correlated. The greater the risk, the greater return potential. The lower the risk, the lower return potential. However, your capital is always exposed to some degree of risk. What determines an asset class risk profile is dependent upon multiple factors, but generally it is to do with its volatility and value and the laws surrounding default. Different asset classes lie in different places along the scale. For example, if we exclude cash, fixed income, otherwise known as bonds, are considered the least riskiest investment because dividends are paid out and therefore an investor can easily forecast their return. To further minimize the asset class risk is creditors, bondholders, are the first to be paid out in the event that the bond issuer defaults. On the other end of the spectrum, excluding alternative investments, equities are considered the most risky asset class because they are most volatile in value, and in the event a company folds and is liquidated, shareholders are lower down in the pecking order of who gets paid out first. Number three, asset allocation and diversification. The idea of asset allocation is that within a portfolio, assets are divided in varying proportions dependent on the investor's risk profile. If an investor likes a bit of risk, they might opt for a larger proportion of equities within their portfolio, whereas an investor who is more risk averse might opt for a heavier weighting towards bonds. There are a lot of factors at play in determining an investor's risk profile, but it is generally to do with the goal of the portfolio and the time horizon that the investor has. If you are 20 years old, you have all the time in the world and you are likely more inclined for growth within your portfolio. Whereas if you're 70 years old, you do not want to be exposed to too much volatility and would prefer a bit more of a steady income, i.e. in the form of a pension. The general rule of thumb is that you want your age expressed as a percentage in bonds. So if you're 40 years old, you want 40% bonds and 60% equities. The point of diversification is to normalize volatility whilst maximizing returns and reducing risk. Number four, everyone has their own view. When deciding to create an investment portfolio, it can be tough to determine what to invest in. You can go to people to seek out help, but they're often not very helpful because they all have their own views. Everybody swears by a certain asset class, whether it be property or cryptocurrencies or exclusively equities. It was what was successful for them, and that's why they're advocating it. But it is your job to determine your ultimate goal, your risk profile, and what your time horizon is. Now in this second point, I'm going to share with you the things that you need to consider whilst investing. Number one, though this seems simple, you are attempting to achieve a rate of return on the capital that you employ. Your rate of return is expressed as a percentage of your principal investment. For example, if your principal investment is £100 and it returns within 1 year £10, your rate of return is 10%, simply speaking. Without getting too techie, more crucially, investors are looking for alpha and know that it's not a man in a leather jacket with multiple sexual partners, but an asset's strategic ability to earn a return that exceeds the market benchmark performance. Whoa! I thought you said this wasn't going to be confusing. Don't worry, I'll explain. Sticking with equities, when you see an index such as S&P 500 or FTSE 100, this is an index that tracks the top X amount of companies, whether it's 100 or 250, based on market capitalization within a particular country's market. S&P is the US, FTSE is the UK. Since you can buy shares in an index or an exchange-traded fund, an ETF, it is very easy to achieve market returns year on year. Therefore, investors seek alpha because that is a portfolio that has outperformed the market and therefore is achieving returns in excess of general growth trends. Number two, do not be fooled by beating the market. Most investors over the long term will never beat the market. I've achieved returns in excess of 100% in certain years, but if I was to do this for 10 years, year on year, I would be a trillionaire. Not going to happen. Therefore, generally speaking, you want to buy index-linked funds across multiple places within the world and diversify with some weighting towards bonds. Number three, upside potential. Let's say you have achieved a return on a particular investment and you want to know when to liquidate your holdings and realize that return. Well, the trouble comes in when you think that this asset or investment has potentially more upside to it. What you must ask yourself is, from the current position, does the potential upside of your current investment exceed the returns of other potential investments? If you believe there to be only a 5% upside to your investment, whereas there are other investments in which you could achieve 10%, the wise thing would be to sell. People often fall victim to the idea that since their investment has performed so well thus far, its performance will continue and therefore it's a great asset to hold. However, one must assess the upside from the current position. Baby, you give me ice and fire. Now in this third point, I'm going to share with you some general principles that you should be aware of when investing. Number one is be aware of your emotions. As hard as you try, whether it is entering or exiting an investment, your emotions will always come into play. I have made investments and watched them plummet by 30%. Thankfully, I knew I was never going to sell at a loss, and given this was the case, I should have bought more to improve my returns, but always never did. I was too timid. Conversely, I've watched investments sit at 25% return for weeks on end, hoping just for a little bit more and then I'd liquidate, only to kick myself after watching it drop to 10%. I was too greedy. People make money on irrational market participants by selling when sentiment is bullish and by buying when sentiment is bearish. Number two, never lose money. The number one goal of an investor, besides seeking a return, is to never lose money. Of course, sometimes it is wise to sell your investments at a loss to avoid a complete and total annihilation of your holdings, but generally speaking, you never want to lose money. This is because of compounding setbacks. If you invest £100 and you sell at a 50% loss, 50 quid, in order to get back to where you started, you will need to achieve a 100% return on your £50, which is very difficult. Therefore, when investing, try not to realize losses unless you believe, through rigorous analysis, that your capital is at risk of total annihilation. Otherwise, if not, you risk compounding setbacks. Number three, it's a marathon, not a sprint. So long as you hold a diversified portfolio of equities and bonds beyond 20 years, no one has ever lost money in the stock market. To avoid any losses and to maximize returns, you want to keep your assets invested for as long as possible whilst reinvesting dividends for the sake of compound interest. Einstein called compound interest the eighth wonder of the world. It's the idea that each year you earn a return, it is not only on your original principal investment, but also the accumulation of returns that you've earned thus far. This gradual accumulation toward the end of the curve becomes exponential and delivers nominal amounts in fiat currency that greatly exceed your original investment. However, it's all about when you start, because it is only until about year 30 to 40 that you start to see huge jumps in the value of your portfolio. Number 4, exceptional returns are lucky. You will likely be a retail investor if you are not a professionally qualified individual as a financial advisor or money manager, and therefore, if you ever achieve returns that greatly exceed the market performance, it was likely luck. Similar to previous points, do not become emotional in the event that your assets negatively or positively deviate from the market benchmark. You might be able to achieve 100% one year, but the statistics don't lie, and they say that more than 90% of investors will not be able to achieve an average rate of return that exceeds the market over the 10-year period. Warren Buffett, considered the greatest investor of our generation, has achieved returns of around about 20% year on year throughout his investment career. Therefore, you will likely not beat the market and should stick to what is tried and tested. Number 5, index investing will get you rich slow. This might be in contrary to some of the advice I've given thus far and to generally advised investment guidance, but there is nobody under the age of 40 who has got rich from index investing. If he or she did, they started with a load of money and entered the market at the perfect time, the bottom. Given this, you should ask yourself, do you want to be climbing in and out of a Ferrari when you are a decrepit fuck and you can barely enjoy it? Probably not. I don't know about you, but you want to get rich when you're young, when you can still enjoy it all, and therefore, if that is your goal, do not delude yourself with index investing. It is for the long haul. And now it is time to end, lovely people. I hope that this video has given you some guidance and pointers on how to invest. It's much simpler than it seems, but requires a little bit of financial literacy. I believe the world of finance and investment to be designed to not be understood by the masses, but with a little bit of education, one can dissect its ideas. And so, thank you all for watching. I wish you the best on your journeys. And if you want bragging rights for being one of the OG subscribers, then you know what to do.
You're giving me wind and rain. You're some kind of butterfly.